You file a claim. The insurance company pays it. You think you won. You didn't. Every time an insurance company cuts you a check, they're not losing money. They're making it. And not just a little. They're making more than if they had denied your claim entirely. This isn't a conspiracy theory. It's not a loophole. It's the entire business model. And it's been hiding in plain sight for over a century. The insurance industry runs on a mechanism so counterintuitive that most people, including the people who work in insurance, don't fully understand it. But once you see it, you can't unsee it. This is about how paying claims became the most profitable thing an insurance company can do. Let's start with what everyone thinks they know. You pay a premium. The insurance company holds that money. If something bad happens, they pay you. If nothing happens, they keep your money in profit. That's the kindergarten version. And it's not entirely wrong, but it's missing the entire second half of the equation. Because insurance companies don't just sit on your premiums waiting to pay claims. They invest them. And the returns on those investments dwarf the premiums themselves. Here's the part that sounds backwards until you do the math. The more claims an insurance company pays, the more premiums it can justify charging. The more premiums it charges, the more money it has to invest. And the more money it invests, the more profit it generates. Paying your claim isn't the cost of doing business. It's the justification for doing more business. Let me show you how this works in practice. In 2023, the top 5 U.S. health insurance companies collected roughly $1.2 trillion in premiums. They paid out about $1 trillion in claims. On paper, that looks like a $200 billion profit. But that's not where the real money is. Those same companies held investment portfolios worth over $600 billion. And those portfolios generated around $40 billion in investment income in a single year. Now here's the kicker. To hold that much in investments, they need to collect massive premiums. And to justify massive premiums, they need to pay massive claims. The system feeds itself. Let me explain the mechanics step by step. When you pay your insurance premium, that money doesn't just sit in a vault. It goes into what's called the float. The float is the pool of money the company holds between the time you pay and the time they might have to pay a claim. For most insurance companies, that float is enormous. State Farm's float is over $100 billion. Berkshire Hathaway's insurance operations hold a float of nearly $170 billion. And here's the critical part. They invest that float. Bonds, stocks, real estate, treasury securities, anything that generates a return. Warren Buffett has said repeatedly that insurance is one of the best businesses in the world. Not because of underwriting profit, because of float. In fact, Berkshire Hathaway's insurance division often operates at an underwriting loss. They pay out more in claims than they collect in premiums. And they do it on purpose, because the investment income from the float is worth more than the underwriting loss. Let's use a simplified example. Say an insurance company collects $10 billion in premiums. They pay out $10.5 billion in claims. That's a $500 million underwriting loss. But during the time they held that $10 billion, they invested it and earned a 6% return. That's $600 million. Net profit, $100 million. From an underwriting loss. Now scale that up and add regulatory advantages. Insurance companies are required by law to hold reserves, money set aside to pay future claims. Those reserves are massive, and they're invested. The bigger the claims, the bigger the reserves. The bigger the reserves, the bigger the investment portfolio. This is why insurance companies don't actually want to minimize claims. They want to maximize the flow of premiums and claims because that maximizes the float. But there's a limit. If they pay out too much too quickly, they lose the time advantage. So they delay, they dispute, they process claims slowly, not to avoid paying, but to hold on to the money longer. Now let's talk about what happens when the system starts optimizing for investment income instead of coverage. Insurance companies operate under something called a combined ratio. It's the total amount paid in claims and expenses divided by total premiums collected. A combined ratio under 100% means they made an underwriting profit. Over 100% means they took a loss on underwriting. Most major insurers operate between 95% and 105%. They don't care which side they land on, because the investment income makes up the difference. But here's where it gets uncomfortable. The regulatory system is designed around the assumption that insurance companies make money by not paying claims. So regulations focus on making sure they have enough capital to pay claims when needed. Nobody regulates the float. Nobody questions whether an insurance company is optimizing for investment returns over coverage quality. This creates perverse incentives. If an insurance company can justify higher premiums by pointing to higher claims payouts, they have an incentive to let claims inflate. Not deny them, inflate them. Medical insurance is the clearest example. U.S. healthcare costs have exploded over the past 40 years. Insurance companies are often blamed for denying care. And yes, they deny care. But they also pay for an enormous amount of overpriced care. Because every dollar of inflated medical cost justifies a higher premium. And higher premiums mean more float. More float means more investment income. The insurance company, the hospital, and the pharmaceutical company all benefit from the costs going up. The only loser is you. And it's legal, completely legal. Here's another example, auto insurance. In the last decade, car repair costs have skyrocketed, partly because cars are more complex, but also because insurance companies don't push back hard on repair shops. Why would they? Higher repair costs mean higher premiums next year. Higher premiums mean bigger float. They'll fight you on coverage, they'll delay payment, but they won't fight the underlying cost structure. Because the cost structure is what allows them to charge more. Let's zoom out and look at what this means for the economy. Insurance is supposed to be a mechanism for distributing risk. You pool resources so that when something bad happens to one person, the group can absorb it. But that's not what modern insurance is. Modern insurance is a financial instrument, a way to generate investment capital under the cover of risk management. The U.S. insurance industry manages over $7 trillion in assets. That's larger than the GDP of every country except the US and China. And most of that money isn't sitting idle, waiting to pay claims. It's actively deployed in the market, buying bonds, funding corporate debt, propping up real estate. When interest rates are high, insurance companies make a fortune. When rates are low, they struggle. But either way, they're not operating primarily as insurers. They're operating as investment funds that happen to sell insurance. This is why insurance premiums don't drop when claims go down. You'd think fewer accidents would mean lower car insurance rates. Fewer medical emergencies would mean lower health premiums. But that's not how it works, because the premium isn't priced based on your risk. It's priced based on what the company needs to collect to maintain its investment operations. The claims are just the excuse. And here's the final twist. When insurance companies do face a liquidity crisis, when they actually can't pay claims, the government steps in. We saw this with AIG in 2008. The federal government bailed out an insurance company to the tune of $182 billion. Not because people's homes were at risk, because AIG's collapse would have destabilized the entire financial system. Insurance had become too big to fail, not because of insurance, because of investments. So here's the question nobody wants to ask. If paying claims makes insurance companies more profitable, why does it feel so hard to get them to pay? Because the profit isn't in paying quickly, it's in paying slowly, while holding your money as long as possible. Every day your claim sits in review is another day they earn returns on the float. Every time they ask for more paperwork, they buy more time. Every dispute, every appeal, every delay is mathematically profitable. You're not fighting a company that doesn't want to pay. You're fighting a company that wants to pay later, and the system is designed to let them. The entire insurance model has quietly shifted from risk management to capital management. The claims aren't the business, the float is the business, which raises an uncomfortable possibility. What if the reason insurance feels broken isn't because it's failing? What if it's working exactly as designed, just not for you? Insurance companies will keep paying claims. They have to. It's how they justify the premiums. It's how they build the float. It's how they make the real money. But they'll pay on their terms, on their timeline, with their math. And the next time you file a claim and they cut you a check, remember this. You didn't beat the system. You fed it.